Hello, ladies and gentlemen, and welcome to CFG's quarterly outlook video for Q2 2021. I'm Alex Leonida. I'm the Chief Investment Officer here at Capital Financial Group, and I do these videos. And one of the most entertaining things for us is getting feedback from clients. And through this last, month, 2 months or so, we've been getting feedback from people saying essentially that most of the stuff I talk about, nobody cares about. Which, as you can imagine, makes a guy feel really, really good about themselves. But in any event, what we're going to do here is we're going to consolidate some things. We're going to try to give the people what they want, if you know what I mean. First, we're going to talk about where we are right now, okay? What's going on in global markets today, specifically stock markets, bond markets, the stuff that people actually care about, or so they say. Second up on the list is we're going to answer the question, why? Why are we where we are? And then last up is going to be, where do I think we're going from here? That one's obviously the most important question, and also probably the least accurate, because even though I have a lot of data and I fancy myself reasonably intelligent, that's the only one that I don't actually know the definitive answer to. I know the other stuff. So we're going to start there. I'm going to hit on all three of those questions. I'm going to finish up, as always, with our current positioning. And then as long as you guys stay with me, I'm going to try to knock this whole thing out in about 10 minutes. Boom, you'll be done. So try to stick around to the end of the video. All right, here we go. What's happening in global markets? That's question number one. First of all, U.S. stocks, probably the most widely followed stocks in the entire world. They have been super duper cooperative. And what I mean by that, if you take a look at this chart, is all U.S. stocks, regardless of size, doesn't really matter. They've been solid performers this year. Different style factors, etc. I mean, obviously there's divergences in some certain sectors doing much better than others, but we're not going to get into the weeds because that's the exact kind of stuff that you guys said you don't really care about. So we have S&P, Dow Jones, NASDAQ, and Russell 2000. The first three are all big companies. Different types of things go into that. We're actually going to release some videos talking about the different types of indices out there, what makes them unique, what makes them useful to follow on a regular basis. And then the last one is going to be the smaller companies here in the United States. But as you can see, everything has been positive on the year, at least from an index perspective, which is nice, right? Obviously, there's been periods of borderline insanity. More people think investing is easy right now than ever before. And those same people that are in that mindset also probably don't even know what capital gains are. So we'll just leave it at that. If you're one of those people, I mean no offense, by all means, shoot me an email and I'm happy to explain what capital gains are. Moving on to international stocks. They've started to pick it up again. If you take a look at this chart, it was a super sketchy start to the year for international stocks. If you guys remember for our last video, we are really on board with outside the U.S. Potential growth finally starting to outperform over the next year, maybe a little bit longer, because of this long-term cycle in dollar devaluation, which has a lot to do with how the U.S. government is spending money. Once again, not going to get into the weeds. I'm just not going to do it. If you want to know more, shoot me an email, give me a call. We'll get into the weeds together, but not on this video. All right, so let's move on to emerging markets. Kind of a similar chart in terms of some struggling recently. But EM has some major tailwinds behind them. And essentially what tailwinds are is that just makes it easier to fly or easier to soar, right? Headwinds being the opposite, is essentially wind blowing in your face, makes it harder to fly, harder to move forward. In this case, emerging markets have a ton of tailwinds. One of the biggest one is going to be the weakening dollar that we just alluded to. It's a big deal for emerging markets because most of those countries, their government bonds are denominated in dollars. We've talked about this ad nauseum in reviews and in other videos, but it is a real thing. The easier it is for them to service their debt, the easier it is for them to spend money and grow. Inflation can be a problem, but what's cool for them is a lot of the emerging market economies rely on inflation-sensitive commodities to fund their governments and their social programs. So a lot of opportunity there. We are still bullish in that space, and it reflects how we have the portfolios invested at the moment. On the flip side, not so bullish on the bond situation. We've kind of talked about this, how bonds have been fighting an uphill battle. They have headwinds, right? Kind of what we were just alluding to, the opposite of tailwinds. It's been tough because bonds have essentially been in a bull market since like Vietnam. You know what I mean? And that's a long time. I mean, that's longer than I am old, which is not a technical term, but you know what I'm saying. And the bottom line here is, you know, bull markets come to an end, and that's okay. That happens sometimes. Nothing to be sad about. You just got to adjust. And the next question is, well, why do we have any bonds in the portfolio? Well, realistically, you always have to have some kind of fixed income in a diversified portfolio, because when random stuff like what happened last March with COVID happens, if you have no bonds, you're a sad panda. That's just how that works. And we've talked about it millions of times. Risk happens really, really slowly, and then it happens all at once when you're not expecting it. So that's why we have bonds, right? There's a lot of stuff going on right now, but I don't know how to put this. It's a unique environment. Let's just call it that, right? So let's answer that question of how and why are we where we are. Try to say that 3 times fast. Not super easy. Not going to do it on video because that would be embarrassing. I'm not going to oversimplify this whole deal too much, but the bottom line is things are really, really good right now. There's a lot of positives going on in this market environment. Let's talk about monetary policy for a second, okay? And fiscal policy for a second. I'm not going to get too far into the weeds with this, but money supply is so loose. Interest rates are so low. The government is spending so many dollars that there's literally almost no way that this couldn't be an inflationary positive for risk assets type of environment right now as we live and breathe, okay? So look at this chart. Money supply. This is straight bananas. We're talking $20 trillion. And this chart that I have right here doesn't even take into account this last round of stimmies. I mean, there's so many more dollars in the system right now. And this chart is crazy. Doesn't even count that stuff. Moving on to interest rates. I just said they're super low. This right here is called the natural rate of interest. You just Google it. It's a super duper fancy little thing that takes into account like GDP, Fed funds policy, money flow, etc. through the system. Bottom line is this chart goes back to really long time ago. Okay? Not a technical term, but it goes back way far. And we are at the bottom. Okay? This is the whole like relative affordability thing. And kind of what I was just saying. I mean, this kind of bull market in interest rates got to stop sometime. They don't go on into perpetuity no matter how many dollars the government wants to spend on it. All right? Let's talk about some more important things like consumer confidence. That's another reason why we are where we are. They are at all-time highs. I mean, we are dang close to the highest it has ever been. We're talking like pre-tech bubble, pre-real estate bubble, whole 9 yards. Consumer confidence is through the roof. Home prices through the roof. Here's a good one, huh? You may not even be paying your rent bills, may not even be forced to pay your mortgage right now. You're going to get a stimulus check. Somebody else is going to pay your mortgage, or even if that doesn't happen, somebody is going to not be able to come after you to pay your rent or your mortgage. And then the value of your house is going to go up. So you're actually going to be getting richer by not paying your bills. And then on top of that, beyond all of these things, if you happen to have a car, your used car is probably worth more than what you bought it for. Think about that. Think about that for a second. What is this? All right, I'm going to calm down. I'm getting a little bit stressed out. But just for good measure, if you don't believe me, look at this chart on used car values. If you owned a car there is a decent chance, as long as you didn't put a gazillion miles on it, that it could be worth 8, 9, 10% more this year than when you bought it if you bought it last year. That's crazy. I mean, nothing weird about this situation. No, nothing to see here, folks. Okay? This is the stuff the dreams are made of, as they say. You know what I'm saying? It's like, let's take it to another level. Used cars are like Dogecoin to the moon and all that, right? I mean, invest in some used cars, invest in some Dogecoin. Either of those make sense? Not really. Nobody cares, though. That's where we're at right now. Think about that, okay? With all that fun and exciting stuff being said, the real question is, where are we going from here? Where are we going? People are really starting to talk greed and euphoria and all that, and based on the condescending nature of a lot of the stuff that I've said here today, I think you know that kind of where I stand on the whole situation is a lot of this is nonsense. But in terms of greed and euphoria, not nonsense. We are totally there. Mind you, there's remaining stimulus in the form of an infrastructure bill. That should be a couple trillion. Also a new bill, whatever was in Biden's address to Congress, $2 trillion here, 1.9, whatever, yada, yada bill. Nobody really knows exactly what that is, other than a lot of people are going to get checks. And then also there is another 10-ish trillion proposed for the Green New Deal. Probably won't be 10, maybe some other number, some other magical number that nobody knows how we're going to pay for it. So basically you add all those together and you get lots and lots of $1 trillion, which is great for business. That being said, people are really just, they're focusing on the fact of how easy investing is right now. And they're wondering why it may seem that way to them. I mean, all I got to say is you take your stimmies that you get from the government, right? You take those stimmies over here, and then you put them in stonks. If you don't know what stimmies or stonks are, that's probably a good thing. But you have a cell phone. I'm assuming you're watching this video on a cell phone or on your computer. Don't pause this video or stop it, but when it's done, I want you to Google stimmies and stonks. You'll see why this is a little bit of a weird thing to me. In any event, if you think putting your stimmies in your stonks is a really good investment strategy and it's too dang easy, all I got to say is you don't want to be the dude at the end of this strategy holding the bag, being the last one out. Because that strategy ain't going to work forever, if you know what I mean. Let's move on, okay? We're not going to pull the plug on U.S. stocks, even though a lot of this crazy shenanigans is mostly centralized here in the United States, and a lot of this crazy stimulus is centralized here in the United States. But we are kind of sounding the alarm that, you know, at some point, barring another infinity $1 trillion, the party's going to have to slow down a little bit because nobody's going to have any stimmies to invest in their stonks. Moving on to international, we think developed international is still going to be attractive because they are 3 to 6 months behind the United States, because they still have bullets in their stimulus weapons. They can still fire euros and stuff into the sky to try to stimulate their economies when the U.S. is out of money. So there's opportunity there. And then for the reasons I mentioned earlier, emerging markets still pose opportunities to invest. Now, this brings me to our current positioning levels. This is my favorite part of every episode or every quarterly review video. Essentially, here's where we're at right now with our outlook and our strategy. Cash levels are about the same. They're still low from where we normally are. We're going to remain there likely into the summer months because we do still have opportunity here in the U.S. with stocks. A slight change is we're going to be ticking back over to more quality in our U.S. stock exposure. As you guys all know, we started moving into some potentially lower quality stocks over the last, quarter or two as things started setting up to be more bullish here in the United States. Internationals and emerging markets are going to remain overweight for all the reasons I already mentioned. We can get into more details. If you guys want to have a review, give me a call. Fixed income is still going to be a little bit underweight because the issues we were talking about, with the bond market kind of rolling over and finishing its long-term bull market. And we're going to start moving back to some more vanilla, more traditional type of bond exposure to help combat potential volatility in the latter half of the year. Remember, for us, data always dictates the positioning in our portfolios. And what we like to do is as that data shifts, as the narratives change, as the macro picture changes, we're going to change our positioning and our investment strategy because we reserve the right to do that. That's what we're paid for. I am eternally grateful that you guys stuck around and watched this entire video. These are super fun for me to make. I am really, really looking forward to having my reviews and chatting with any of you that have questions or do want to get into the weeds about anything that I've talked about in this video. I ask that if you have questions, you shoot them over to info@cfgfinancialplanning.com. Remember, hope is not an investment strategy. You all take care and have a wonderful start to your summer.